Traditional office spaces are sitting empty. Driven by permanent hybrid work routines and elevated financing costs, commercial real estate is caught in a severe, sustained slump. That poses a massive problem for large institutional investors. Pension funds and mega asset managers rely on these massive concrete towers to generate predictable, decades-long streams of income. Now, those same investors are looking at structurally dormant assets. High-rise buildings across major cities are bleeding tenants, and the capital tied up inside them is sitting idle. To protect their balance sheets, these funds are aggressively hunting for defensive assets. They need investments that people physically cannot live without, making them naturally resistant to inflation and broader economic shocks. The trillions of dollars managed by these institutions aren't disappearing. The capital is simply packing up, leaving the empty office districts behind, and moving directly into the neighborhoods where we actually live. We now have a clear look at what this rotation of wealth looks like in practice. Equity Residential and AvalonBay Communities have officially agreed to a historic all-stock merger. By combining forces, they are instantly creating the single largest publicly traded apartment platform in the United States. Both companies operate as real estate investment trusts, or REITs. This is a specific financial structure that lets huge pools of institutional capital buy, own, and profit from everyday rental housing at a national scale. This comparative bar chart breaks down the true financial weight of the agreement. At an enterprise value of $69 billion, the newly combined entity completely dwarfs traditional mid-tier residential portfolios. Executing a deal of this size right now requires extreme financial confidence. Commercial real estate has spent the last 2 years battered by high global borrowing costs, yet these two corporate landlords are doubling down. When institutional capital needs a stable harbor to weather an uncertain economy, it builds that position out of large-scale residential housing. Acquiring properties is easy, but sheer size alone doesn't guarantee a profit. To make a $69 billion merger worthwhile, you need extreme geographic density. Looking at this map of the United States, you can see exactly why these two specific portfolios are merging. The colored dots representing their respective properties converge with a 95% overlap across major metropolitan target markets. Because their buildings are located in the exact same neighborhoods, the new combined company can instantly merge their regional management teams and centralize all localized services. This area chart visualizes the immediate financial payoff of that density. By stripping out redundant overhead, the merged entity expects to generate $175 million in pure operational synergies within the first 18 months. Slashing operational costs drastically improves long-term operating margins. They are making their underlying assets vastly more profitable without needing to pour concrete or acquire a single new building. To execute this streamlined strategy, Equity Residential CEO Mark Perrell will retire, handing control of the consolidated empire over to AvalonBay's Benjamin Schall by the second half of 2026. The ultimate goal here is localized control. By dominating specific urban zip codes, they strip out the cost of competition and maximize the yield of every square foot they own. Managing a consolidated portfolio of this density requires moving beyond traditional property management and turning the physical buildings into a unified digital network. Both REITs share a crucial technological foundation. Prior to the merger, both companies poured investment capital into a specialized property technology firm called Elise AI. They deploy artificial intelligence systems to automate the tedious friction of property management, handling tenant engagement, running background checks, and the entire leasing process with minimal human oversight. But the most powerful tool is algorithmic rental forecasting. The system processes massive localized datasets, allowing the company to calibrate rent prices across tens of thousands of individual units in real time, based on micro-fluctuations in demand. The company uses this $69 billion physical footprint to generate a continuous stream of real-time data, converting physical apartments into a high-yield automated revenue network. A deal of this magnitude sends a glaring immediate signal to international capital markets. Global institutional investors are now officially prioritizing the resilient, recurring income of residential and logistics-linked assets over traditional commercial office space. We can already see the ripple effects in emerging international markets. In sectors like South Africa's REIT market, property groups are under pressure to adapt to this model of efficiency or risk losing access to international capital. To attract global money today, a property company must now provide immense physical scale, unified data integration, and automated property management. This merger establishes scale and automation as the new requirements for attracting large-scale institutional investment. For the world's largest funds, residential real estate is increasingly viewed as a standardized, data-driven income stream.